Welcome to another edition of the Chit Chat Stocks podcast. We have a fantastic interview for the listeners today. There's been a lot of talk. There's been some legislation, a lot of press releases, product announcements around stablecoins and the fintech space, and it's become a huge point of discussion within the investor community. So that is why we wanted to bring on Jev from Popular Fintech newsletter, fintech expert, someone who's worked in the industry a long time. So, Jev, welcome to the show. And I have an introduction question from a Twitter user that I think can inspire the discussion and what we're going to talk about today. So, thank you to the Twitter listener for saying this. Here's the question. I'm just a dude who works 80 hours a week, buys Starbucks on occasion, drives a Nissan Versa, and caves in immediately in an argument with his wife because I just don't want to deal with it. What can stablecoins do for me?
Hi, really excited to be here. I think it will be a great conversation. Should we jump into this question or let's try to make it a theme and arrive at the conclusion at the end?
Yeah, we could actually keep it as a teaser and we could start out with just what are stablecoins. But either way, however you want to go about it, maybe just explanation, what they are. You go with what you want to
do. Sure. All right, let's start what stablecoins are. Stablecoins are essentially a representation of money on blockchain, a token that is pegged to specific currency, whether it's dollar or euro, and that can be used on blockchain. How I try to frame it is there used to be a time when people would get the salary in cash, bring it to the bank, and the bank would essentially turn cash into digital money. And this digital money opened a whole magical world. Right? You can buy stuff online, you can travel globally with your linked debit card and spend your money. You can send it to your friends instantly over Venmo. So many things became possible because money became digital. And so if you think of stablecoins, you come to an issuer, let's say Circle. It doesn't really work like that with consumers, but let's assume it does, right? You come to Circle with your fiat money, and Circle gives you a token, which is equivalent of your fiat money on blockchain. And then blockchain essentially opens up you a new magical world of possibilities that you can do on blockchain. Right? Currently, this is very limited. Right? You can send the money across the globe instantly. You can earn higher yield through lending protocols. Maybe do a few other things. Trade on decentralized exchanges. Right? But this is the very essence. Right? It's your entry into the world of blockchains.
And I do want, maybe we can go back to that initial question, which is, and we're going to talk about the different industries where stablecoins can maybe have an impact. But when we think about transactions and the use case here from our Twitter listener, where it's like just, I think he's painting himself as just the average Joe who wonders, how are stablecoins genuinely going to impact me? What do you think are some of the nearest term applications for stablecoin adoption for, in this case, the average Joe?
Yeah. So it is absolutely a fair question, and the fair answer would be not much at the moment, right? It is still a hypothesis, right? That the essentially the bare infrastructure and openness of the system, so open architecture, can allow us building bare things that we have now. Those things are not built yet, and I don't think we have even formulated what are those things. I typically hate analogies, so I will not bring the horse in the car, but let's take a more recent example, the mobile phones, right? If you remember Nokia phones, right? I mean, those were amazing phones. call anybody. Barrier lasted a week or two. You could hammer nails if you wanted with that, right? So we're amazing devices. But then iPhone came. Kind of also can make the call. It was worse. The barrier was dying in hours. Network was dropping, but it had GPS, and now we have Uber, right? So essentially, the barrier technology enabled things that were not even possible before. And maybe us walking with Nokia phones around, we did not imagine, not calling a taxi company, but making a few taps on the phone. And then it's more, right? So data, they have more powerful processors. So kind of all the messaging and streaming became possible. But there was even more, right? So Apple opened the App Store and then essentially allowed, hey, look, come and build on that. And people started building all kind of crazy stuff on top of what was essentially a mobile phone, but it had all these technological capabilities, right? It could process more data, process more fast. It had a bigger screen, better resolution, and so on and so on. And I think we're pretty much there with stablecoins, right? So we are discussing kind of what to do with them. Current applications are pretty basic. In most cases, the existing experience is better, right? Than the experience with stablecoins. But it is not about that. It's literally the superior technology, the open architecture that bring the hope that we will build better services on top of this infrastructure. So again, back to the question, it's like today, not much. In 10 years, probably a lot of things that we cannot even imagine nowadays.
Okay, well, I know the listeners of our show, and they are probably interested in what could be the impact over the next 10 years and how it can impact any stocks in their portfolios. We can talk first, I think, about how these things could work in looking at specific sectors. So I want to talk about how, this is one that's close to my heart and Ryan's as well, so we're going to choose them first. Remittances, how could they affect the traditional remittance market?
Are you Team Remitly or Team Vice?
Both. All right.
Both.
Yeah, both.
All right, let's talk about remittances and just cross-border payments. I think a brief intro of how money moves across the borders would help, right? I believe sometimes people kind of miss what's happening under the hood. In some cases, people see the end consumer experience and make judgment that, hey, it's fine. Maybe it's fine for you as a consumer. It's not fine for a merchant or your issuer or somebody in the value chain. Right. A great example is chargebacks, and fantastic thing for consumers. Every merchant hates them. So let's start with remittances, right? And we can kind of transition to card networks and other payment rails that we have. So people use SWIFT to move money. SWIFT doesn't move the money. SWIFT is just a messaging network, right? This is a global network that helps banks and different financial institutions talk to each other through a set of standards. So I'll give you an example how I could, for instance, send you money in dollars over the existing rails. So I come to my bank and say, hey, I want to send money to Ryan. Let's say Ryan has an account with Chase. So for my bank to do that, they need to go to someone like Citi or JP Morgan or Deutsche, or what we essentially call correspondent banks, and say, hey, we want to allow our customers to send money in dollars right across the globe. Citi will review, right, the bank. They essentially hold the keys. They can say, no, we do not trust your policies. We do not like your clients. They're too risky. We will not act as your correspondent bank. No, it's kind of, it raises smiles, but it is a reality, right? There are a few large correspondent banks, and they essentially control who gets to play, who's not. So my bank essentially signs an agreement with Citi, And then what happens is my bank opens an account in CDUS and puts dollars in there. So when I send now dollars to Ryan, my bank takes euro from me, right, or converts them, sends a Swift message to Citi US and tells, hey, send this money to Ryan. So Citi would take money from my bank's account with them, right? So it's just an entry on the ledger, and would send it over domestic rail in the US to Chase account, right? So you see, in reality, the money doesn't move across the borders, right? It was there in the first place, right? So my bank has to figure out how to fund that account, how to put the money on their account with Citi US, so my bank's clients can send money in the US. And imagine if you want to enable multiple currencies, right? You want to send, I don't know, Polish zloty and Hungarian forints and Mexican peso, and so you need to find Citi for pretty much every currency, right? And so on and so on. Right. So this is what we are up against, right? And then to Remitly and Vice, and I've been saying it quite frequently. My thesis about what Vice is building, Remitly, is a bit different. What Vice is building, they are essentially building a modern correspondent bank, right? They are the Citi. Citi's crown jewel is its global network, right? They have banks in many countries. They have the licenses. They have the connectivity to local payment trails. This is why they can actually move the money for the corporate clients, and they can offer it to other banks, right? So, but the way Vice moves money is the same, right? They essentially have this pre-funded liquidity pools and all the corridors. So they have the money in the US, they have the money, I don't know, in the Philippines, and they have money in Mexico. So for you, when you send the money to that country, they have the money locally that they could send over domestic, cheap and fast rails, right? So for you as a consumer, it's kind of magical. In reality, it's pretty much the same thing, right? It's just what happened is that they don't have these correspondent banks in the process. It's their own process, right? They control how fast money moves and the messages moves, right? So they are essentially pretty much doing the same thing with the modern technology and better processes, right? But it's still the same thing. It still requires having those pre-funded accounts. Now let's look at if I send you money over blockchain, right? So I send you stablecoins. Let's for now kind of put aside the question of on-ramps and off-ramps, right? Let's assume that I have USDC and you have an address to send it to, and I happen to know this address. So the money kind of actually does move, right? It's the money doesn't sit in any country, right? It doesn't care where I'm based, right? It's somewhere on the blockchain, right? Across all the different computers across the globe, and the money actually does move instantly, right? So when my bank tells Citi, hey, send the money, it's actually just a message, you know. The settlement happens, you know, the next day, right? In the stablecoin transaction, the money moves right away. It actually does move, right? Not some kind of entries between different ledgers. It really moves from me to you, moves instantly, right? And that's it, right? That's the magic.
Okay, can I pause you there, Jeff? So let me kind of walk through this transaction as I'm understanding it. Basically, Jev, you open a wallet with a wallet provider, which I think that's basically like Circle or Coinbase or something like that.
No, essentially, yeah. So let's walk it through, right? So for now, you as a consumer cannot come to Circle and say, "Hey, I'll give you dollars, give me USDC," right? So you need to come to one of their partners. Coinbase is a huge partner for them, as everybody is now aware and read the agreement, the revenue share agreement, right? So you come to Coinbase and say, hey, you deposit fiat over local rails. For instance, in Europe, they use SEPA Instant. So for me, topping up my Coinbase account is instant, and I can convert on Coinbase my fiat into USDC, and then I can move it to my self-custodial wallet on blockchain. What happens under the hood is actually, Coinbase at some point comes to Circle, says, here's fiat, and Circle mints those tokens, right, and sends them to Coinbase's exchange address, and then I essentially buy from Coinbase already pre-minted stablecoins, right? But I guess maybe in the future, right, so there will be a process to buy stablecoins directly, right, that you could essentially come to Circle, send them fiat, and they would give you back stablecoins, right? And the opposite way, right? You send them stablecoins, they give you back fiat, right?
Are you tired of moving money between your bank account and brokerage account? Well, with Interactive Brokers, there's no longer a need to have a separate high-yield cash account. Interactive Brokers offers up to 3.83% interest on instantly available cash. That means if you've got some cash sitting in your brokerage account and you're waiting to deploy that money until you find your next great investment, now it's actually going to be earning something in the meantime. This is just one of the hidden advantages that comes with being an IBKR customer. They simply do not cut corners, and I constantly find myself surprised by just how much they're willing to do for customers that other brokerage platforms are not. If you're interested in checking them out, head on over to ibkr.com. Restrictions apply. Interactive Brokers is a member of SIPC. And so Coinbase allows, as the custodian, you to convert fiat into USDC in your wallet, and then you can send that USDC from your wallet to the recipient's wallet.
Exactly. Yep.
And then on the whoever's on the other side, they can pull from USDC through their custodian USDC back to whatever their fiat is.
Exactly.
And I know we didn't want to talk about the on ramps, off ramps. We're holding off, but is there? Because that sounds like it's zero cost, essentially, like that, specifically going from wallet to wallet. What about going from taking the money out of your custodian to your bank account? Is there going to be friction there?
Yeah, it is, right? And this is one of the arguments, hey, we don't talk about the cost of on-ramp and off-ramp, right? Because, okay, I send you USDC, but you really don't have kind of where to spend it, right? So you still probably need to convert it, and your exchange would charge you money for that. That's clear, right? So, but let kind of think a bit ahead, right? And I'm kind of trying to paint a bullish thesis, right? I think there are plenty of bear theses on Twitter. You don't have to look far. So I'm being a bit optimistic, but I'm kind of being open that this is still a thesis. Let's say over time there's higher adoption of stablecoins, right? So what if companies start paying you in USDC, and you can spend this USDC either through a wallet or a card that is linked to your self-custodial wallet. So why would you even convert to fiat, right? It's essentially, if you get the money in stable coins because for your employer it is more convenient and you can spend it, right, then the need of this on-ramp and off-ramp kind of disappears, at least partially, right? And second part, this on-ramp and off-ramp is somewhat similar to a fixed transaction in the fiat world, right? And then if there is a demand, there will be competition, right? Because there's not such a difficult transaction. Yes, you have to do probably KYC on to do that, but in reality, it should be pretty simple to do, and then essentially the cost of these on-ramps and off-ramps will go down, right? So I expect these two things to happen, right? So the need to to convert from fiat to stable coins to diminish, and also the cost of on-ramps and off-ramps to decrease.
Interesting. So maybe the players that are already trying to drive down fees can benefit from this if they take on stablecoin adoption. And then, I guess, correct me if I'm wrong, but would you say the number one thing that stablecoin issuers want to do is get stablecoins accepted as a form of currency or a form of payment at your local grocery store, any online payment terminal? That's the key to actually building this ecosystem, which leads me to how this could impact the credit card networks and merchant acquiring, store terminals, the existing, business to consumer payment process.
Absolutely. Right. So stablecoin issuers, particularly, let's say Circle, which is now a public company, so you can look up how they make money. They currently, in the current setup, they just make money from the interest that they earn on the reserves. Right. So when you give them the fiat and they give you back the USDC token, they don't keep this money in fiat. They put them into short-term treasuries and deposits with the banks, and they earn the interest on those funds. So for them, kind of the key metric is how much USDC is in circulation, right? And currently it's something like 61 billion, right? The total market cap of stablecoins is 250 billion. This is nothing, right? This is still kind of limited adoption, right? So that people use stablecoins, right? So clearly they are motivated in increasing this adoption, because then they would have more reserve, earn more interest on those reserves. And then you touched on very important parts, right? So someone is also interested in distributing. So for instance, Coinbase allows for free conversion from fiat to USDC, right? There is a kind of Circle is clearly paying them, right, and through this revenue share agreement, right? But Coinbase is also playing a long-term game, right? They want to give it in the hands of customers, right? Let them kind of experience it, let them start exploring what are the use cases, give it in the hands of companies, developers, everybody around, right? It's they even kind of pay rewards, right? They cannot pass the yield, but they would pay you rewards for holding USDC, right? It's again kind of essentially the goal is very simple, right? To drive the adoption, right? So let's get it in the hands of as many people as possible, and let's build around it.
Okay, so I think I'm following, and to kind of relay this back to the initial Twitter question, which is like, how does this impact the lives of the individual person? There could be a world in which he mentioned that he buys Starbucks on occasion. He could go up to Starbucks, pull out his Coinbase app, which holds his wallet, which holds USDC. You've described the process in what it takes to get fiat to USDC, and you've mentioned that Coinbase does it for free. He could potentially, theoretically here, if Starbucks were to accept USDC payments, I don't know if they've ever announced anything like that, but let's say they did, he could then pay. It's instantaneous transfer. There's no, you strip out the 2.5% or whatever it is from Visa and MasterCard, and then Starbucks has USDC. And in a world where everyone's accepting USDC, they can then pay their employees with that, essentially. But whatever that off ramp is for them, that's
what happened. How do you accept the payment? Because those businesses aren't going to exist without those fees.
Let's touch on that, right? This is also important question, which I believe sometimes is sort of misunderstood. So let's start with acceptance, right? So you are absolutely correct, right? So currently there is a lot of experimentation of how to enable stablecoin spend, right? So how I send you USDC, how do you spend it? Of course, I mean the trivial use application is that, hey, let's give a special QR codes to merchants, and you would pull up like Coinbase wallet with your USDC, and that would be like, but this is not how retailers work. Ask if any merchant or retailer would want another terminal in the store, right? And then they need to somehow reconcile all the stuff. They spend like decades trying to kind of build the processes of how they reconcile all the transactions. They really don't want to do it, right? So there are some kind of adventurous folks, right? The Coinbase had this campaign of, hey, you can buy coffee with USDC, but like practically, for merchants, this is a dead end. So what another dimension of this experimentation is that people are building cards that actually work off your USDC balance. So think of a debit card, right, that is linked to your bank account. In here, it would be linked to your self-custodial wallet, or non-self-custodial but still a wallet, right? So for the merchant, nothing changes, right? You tap a card under the hood, you're charged USDC. Your issuer of the card settles with Visa in USDC, which is already possible. Visa allows issuers to settle in USDC, and then the merchant can decide how they will want to get the money, whether they want it in fiat or they want it in USDC too. Right, so this is kind of the next evolution, right? So we still use the card rails and all the POS terminals, right, and all the kind of reconciliation infrastructure that is built around POS terminals and card acceptance. But underneath, that would be not fiat, but stablecoins.
Okay, so I think I'm following. So I guess my next question would be, what if I like my credit card rewards? Like, I know it's still maybe the merchant saves some money in that transaction, but as a consumer, I like my credit card rewards. Is it possible for those card issuers to offer some sort of incentive program like that? Sound the alarms, new sponsor alert. This episode is brought to you by TSOH Investment Research. TSOH is run by recurring guest and friend of ours, Alex Morris. Inside his research service, subscribers get access to 6 high-quality stock research reports per month, including initiation reports, as well as regular updates on current TSOH holdings and watchlist stocks. Plus, there is 100% portfolio transparency on the service. This coverage includes companies like Airbnb, Celsius, Roblox, Netflix, and many others. TSOH is a premium research service. If you're serious about investing, this is like outsourcing a professional analyst. We read his write-ups every week, and to be totally honest, I lean on him for quarterly coverage on many of the stocks I own. If you are interested, head on over to thescienceofhitting.com. The link is in the description. Again, that is thescienceofhitting.com. All right, folks, if you are a regular listener to Chit Chat Stocks, then you know that we use Fiscal.ai, formerly known as FinChat, daily. Fiscal.ai is our complete stock research terminal. It's where we have our investment dashboards. It's where we create financial charts. It's where I read all the transcripts for conference calls, sell-side events, shareholder meetings, and it has Morningstar's high-quality reports on more than 1,700 companies. It really is the complete research platform for stock-focused investors. If you use our link, fiscal.ai/chitchat, you will automatically get 2 weeks of Fiscal Pro for free. And if you find that it's worth upgrading, which I think you will, you'll get 15% off any paid plans with our link. Again, that is fiscal.ai/chitchat. The link will be in the show notes.
Now let's talk about the rewards, right? Because somebody is paying for the rewards, right? So let's try. Let's walk a bit, through where the rewards come from. First of all, that's the merchant, right? So they pay to the acquirer. By scheme rules, part of this fee goes to the issuer, right? So essentially your bank that issued you a card. This is what's called interchange. So they can share some of that interchange that you earn with you in the form of rewards. And this could be not kind of even distribution, right? So you need to hit certain threshold, right? So they would earn interchange on every transaction, but only if you spend, I don't know, $5K a month, then kind of your rewards start making any sense, right? And then you can do something. So essentially the high spenders get the benefit, the low spenders don't, but bank gets the interchange every time. Right? Then there's second part, right? So this is essentially revolvers funding transactors, right? So in credit cards, there are typically two types of customers: those who pay off the balance and those who don't. Right. So and then essentially the bank or your issuer starts earning interest, and you can use part of that interest to create rewards. Then there is monthly fees or annual fees, like in case of Amex, right, that compensate part of those rewards. Then there are special deals with merchants again, right? So, for instance, Amex comes to, I don't know, a restaurant chain and says, hey, we will promote you in our rewards program, but you need to give us, I don't know, 5-10% discount for our members, right? So essentially, you see, kind of all of these things are paid by someone, right? This kind of money doesn't come out of the air. Right, and part of it comes from the merchant. You know, there's nothing in the scheme that cannot be replicated on blockchain. Right. So recently, I wrote about Coinbase commerce payment protocol. Right, where essentially Coinbase worked with Shopify, and they said, okay, this simple wallet-to-wallet transactions don't really cut it for merchants, right? The commerce is a bit more complex. You know, sometimes you have to refund transactions, right? There has to be some kind of fees paid in this transaction, right? So this simple account or kind of wallet-to-wallet transactions don't really cut it. And they build the whole protocol, and this protocol has all this mechanism, right? They have a mechanism to charge a merchant for accepting USDC. They have a mechanism to reward an issuer, right? The same way as issuers are rewarded. So back again to your question, and sorry for long intro, but I think it's worth revisiting, right? How those rewards kind of happen to be. There's nothing that cannot be built on blockchain, right? And currently we already start seeing things like Coinbase Commerce Protocol that does pretty much all of that, right? Out of the box. But you don't have the network in there. You don't have the time lag between the authorization and the settlement, right? So there is no cost of money. There is no credit risk, right? Because sometimes issuers fail, right? Sometimes acquirers fail. All kinds of things happen before the transaction is settled. All of that is gone because the transaction kind of the value moves immediately, right? So, and these are just kind of very basic benefit of stablecoin and running it on blockchain network, not on Visa or MasterCard. Right, this is something that is obvious, very on the surface. Right, we haven't even touched the programmability. We haven't touched the open architecture of that. This is purely kind of one-to-one. Right, like, hey, you can build all of that just in kind of instant settlement. Right, so completely eliminating lots of risks and costs on the way.
You've described sort of the ways in which it could be used for transactions. And we've primarily been talking about USDC as sort of our example stablecoin here. Who else, what other organizations or startups or whatever should or could be launching a stablecoin? Can anyone launch a stablecoin?
Pretty much, yes. Right, and there is even more. Anybody can launch a chain to run this stablecoin on. Right, so USDC is second largest. The biggest one is still Tether. Right, so I think the kind of the positioning of the two is, one is, we are for freedom and self-custody and what's not, right? So USDC says we're the most compliant stablecoin. So an example is that in Europe, we now have the regulation, MiCA, and then Tether decided that they don't want to be compliant. And so exchanges cannot even offer you that, right? So in Europe, you have to use one of the compliant ones, and that is USDC is fine. But then PayPal has its own stablecoin, right? PY, USD. Robinhood, with a few other partners, just kind of launched together with Paxos global dollar, right? So USDG. Quite a few of them, right? So it is not that hard to launch them, right?
And I saw that Amazon and Walmart were quote unquote exploring launching a stable coin, or was I reading that article incorrectly?
No, you're correct, but somebody replied to that. Of course, there is like a huge payments team in Amazon. It's their job to explore it, right? If they can cut costs, they have to explore, right? It doesn't mean
huge cost for them, yeah.
Exactly, but it is still kind of network is still a huge cost for them, right? So and of course they are curious how to eliminate it, and then of course they're exploring. I think what occupies my mind is that Visa is not sleeping, right? Visa is all over this innovation. They are experimenting with issuers, right? They are experimenting, kind of investing in companies that experiment on blockchain and stablecoins. And I'm thinking that maybe Visa will actually launch its own blockchain. Right? So it would essentially, instead of leaving this kind of the opportunity to somebody of building it on Ethereum or on Base and using USDC, Visa will say, hey, here is the compliant blockchain, all the benefits of instant settlement, 24/7 availability, all that, but with the quality stamp of Visa. And the funny part that for them it will actually be super easy to decentralize it. They can enforce that every issuer and every acquirer has to run a node if they want to participate. So if they decide to do it, I think they can.
Right, they have a lot of acceptance around the world and a lot of cards already.
Exactly, and exactly right. And they will say, same rules, but we don't use those kind of domestic rails and the messaging system, the VisaNet that we built. We will just build it on blockchain and kind of keep that opportunity to ourselves. Right?
Interesting.
It is one of the scenarios, right? So and because you see, I mean, Robinhood said that they are launching their own chain, so probably there will be many chains, and go figure who will win, essentially.
Right, and that would make sense for especially trying to tackle the international market. Now, what I see a lot of announcements around stablecoin issuers trying to, I don't want to call it exactly replicate, but that's sometimes how you can see it. They're trying to get bank charters, or they're buying bank charters by acquiring companies. Why are they doing this? And are they trying to just replicate the existing financial system with more efficiencies? Is that the end goal here?
Here's maybe my take, right? So in the US, in order to access FedWire, right, which is how banks move the money between themselves, you have to be a bank, right? You as a fintech cannot get access to that, right? It's just a requirement. You need a banking charter, and then there is a separate application, right, with the Fed to get a master account, and that gives you a lot of flexibility. So if you think of Circle, right, let's leave aside all the kind of regulatory requirements and so on. Just for them, getting a charter, getting access to the local rail means that they can do on-ramp, off-ramp without any partners, right? You can send them fiat, your dollars, right, or from your bank, they'll send you back USDC, right? There's nobody. So essentially, they will control the whole value chain, right, of on-ramps and off-ramps, because they have this access. And I believe this is kind of one of the one of the key reasons why they do it, right? At least this is absolutely why Wise does that, right? They want this access, right? They don't want to have a partner in between them and the local US rail, right? As I said, eventually the money doesn't move across the ocean. It kind of stays where it is. It's purely accounting entry, but it does move domestically over domestic rail. Right, so for Wise, this is really accessing the payment trail to enable those cross-border transactions. For Circle, I believe it is to enable on-ramp and off-ramp without having anybody in between.
Right, and I could see, I guess I'm just kind of spitballing here, some of these modern remittance players trying to adopt, USDC or something like that within their process. Is that going to turn into a competition, or could they be collaborators?
This is one thing that I actually don't understand. So Krista, right, was asked on one of their next calls how they see use of stable coins in their business, and he said something like, when we will see that this can improve the quality of our service or drive down the cost for our customers, we'll explore it, but there is nothing to report on this subject right now. So essentially he was saying that, no, the way we do business is still better than what stablecoins can enable us to do. I've heard, Vice's compare, Rolex, right? The founder wrote a tweet that, he doesn't see a value in stable coins, right? A very heated discussion that kind of people trying to persuade him, why there is a value, right? And he's pushing back, right? Because he clearly understands this business very, very well. Right, and then just like yesterday or the day before, people spotted a few open job openings at their Rolex hiring for stablecoin engineers. So at least they will start experimenting, right? But again, back to my thesis, right? I think there is absolute value for these companies, at least to enable this internal money movement, right? That maybe, yes, for kind of the last mile will run on the local rails, but them kind of moving the money across Vice UK to Vice US or Vice India, can definitely work on blockchain.
Right, especially if their whole value proposition is we're trying to reduce costs as much as possible compared to Western Union or the big banks.
Exactly.
Oh, all right, now you're talking about rapid adoption or not rapid adoption, but adoption across, let's say, the United States. We'll use that as an example. What does the U.S. government do about this? Maybe you don't know or have this is maybe kind of a curveball in the situation, but would they argue that we already have a digital currency called the U.S. dollar? What would they be okay with this? Like if trillions and trillions of dollars were USDC and converting to that, and that's where all the power was.
Yeah, but you see, kind of the current administration is very pro crypto, right? I mean, the Genius Act was passed. There's more legislation coming, essentially building the legal basis for stable coins. I mean, banks now can do crypto, right? So SOFI is back in the game, right? So clearly they will try to become on-ramps and off-ramps to stablecoins, right? Especially as stablecoins kind of find their use cases and find the adoption, right? This is why I was saying that, the cost of on-ramps and off-ramps will go down because, every bank can essentially pretty quickly spin up on-ramp and off-ramp, right? And the tech is there, the legal basis is almost there. There's no hostile regulator anymore to prevent that, right? So they would participate in that, right? But again, right, it is really early start. Kind of the main thing is adoption, right? So what is it that will make spend USDC instead of fiat on buying things, and what is it that will make companies pay salaries in USDC over over fiat and so on.
Before we move on, I want to talk about Blue Chippers Club. Blue Chippers Club is a tight-knit community of stock-focused investors. Inside this community, everyone gets to share and break down their portfolios, pitch stocks, receive feedback, and participate in weekly calls. I recently shared my reports on the real brokerage, Mexican airports, and Airbnb on the forum this year. Tired of the spam and chaos on Twitter? Then you'll love the like-minded stock-focused community on Blue Chippers. When I first got into investing, a role model of mine recommended that I build a network or community of friends to bounce ideas off of, and Blue Chippers Club does just that. If you're interested in joining, head on over to bluechippersclub.com and hit apply. The link is in the description.
So going back to the discussion, we talked briefly about Visa and how it could potentially be implemented there. We got a lot of questions about Visa and MasterCard, as you might imagine, since they seem to be, everyone seems to think they're at risk in the stablecoin world, which I guess sounds possible. But let's say Visa did become the disruptor to themselves in this case. Wouldn't that really hurt their existing business?
I think it would, right? But again, let's step back and discuss very briefly how Visa and MasterCard actually work. So Visa and MasterCard are somewhat similar to SWIFT. They are the messaging networks, right? For you as a consumer, the transaction seems to be instant, right? You swipe your card or put it in the POS terminal, kind of the transaction is done, right? In reality, it's just kind of messages traveled around the globe and kind of there was a handshake between the merchant and the issuer that the money will come, don't worry, right? But then there is the settlement process, right, where Visa calculates who owes whom, right, across the globe, and then starts moving that money over the same rails as everybody else, right? So they move it domestically over domestic rails. They use like correspondent banks to kind of seal the money across the borders to actually settle that transaction, right? And then in the US and Europe, the settlement is super fast, and in Brazil, credit cards are settled in 30 days, right? So you see, essentially, they're doing the same thing as banks sending money over SWIFT, as we say it, right? So there is this cost, and I wrote, I believe, yesterday, right, that they report cross-border transactions, right? This is one of the key drivers. Why it is costly for them, it is more difficult for them, right, to move the money across the borders, and they charge extra for that. They charge extra for that, acquirers charge extra for that. And then essentially blockchain would eliminate this bit, right? There is no reason why it should be more expensive than a domestic transaction, right? If this transaction is actually settled over blockchain rail, right? And there is like no objective reason, right? So anybody could go and challenge, why are you still charging us extra for that? And this is not only Visa and MasterCard, PayPal, right? For PayPal, this is also very critical revenue source, right? If you try to multiply, how much money they make on extra surcharge for cross-border, this is an important part of the transaction margin, right? So I think kind of this is very simple, right? Very straightforward, kind of pretty much next evolution step, right? So somebody will do it, right? If not themselves, and clearly they have very limited motivation to do it, so probably need to have some kind of trigger to that.
Right? Yeah, so, a little kick in the butt for that.
Yeah. No, I mean, you see, it's still a oligopoly, right? So maybe who blinks first, right? And then maybe Master will, right? Because there is still a competition between the two, right? It is a oligopoly. Maybe Amex will create some kind of better rail, right? Because Amex still in Europe, they are a challenger. They don't have the coverage of Visa and MasterCard, right? Maybe they will make it kind of their application, right? So I really think that the kind of few years ahead will be super exciting, and
yeah, I mean, sounds like there's a lot of uncertainty, a lot of paths for change within payment transactions. I think that's all our questions regarding stablecoins and the payment landscape. We got to get 45 minutes there. I think listeners will really enjoy that. But we have a couple follow-ups on your broader fintech coverage. The first one I have, and then I'll let Ryan go after this. What is an important topic in fintech or payments that you believe we aren't talking enough about today, say, as the investing community?
One thing I still don't understand why why there are no more people moving from banks to fintechs. Right? Kind of maybe first few years, right? Maybe even like first decade, we were saying it's inevitable, right? Like we kind of people used to bank with the bank, they got their account when they were teenagers, so there's some loyalty, but and then there is kind of it's still an effort to change your bank, right? Even if somebody else is paying higher rates. So what is it, right? Because like it's been like what over a decade now, right? And it is still working, right? So Bank of America
laziness.
maybe, right? So Bank of America is like their average cost in retail banking is like 60 bips.
Yeah, well, I'll give you an anecdotal example. I still have an account at Bank of America, but I try to minimize as much as possible the amount of money I hold there because I think I still get direct deposits to that account.
Yeah.
So I don't think I'm actually making them much money. I transfer most of it to an actual high yield savings account and try to use, whatever, maximize my personal finance stuff in that way. But I totally understand where Bank of America provides a terrible value proposition if I'm going to fully use them for my personal finance needs. But hey, I still have an account open.
Yeah, but you see, kind of you are an exception clearly. The data tells you that you are an exception.
Right. They
Right?
have
Because
trillion deposits.
exactly right. Trillion deposits, some of them like not paying anything, right? And literally, money sitting on accounts earning nothing, and people still don't switch, right? So this is something that I kind of don't understand, right? Okay, there is probably some risk, right? But in the US, kind of still, it's not like in Europe we have mostly money institutions, right, which have different kind of protection, right? I mean, kind of fintechs like Chime, they still bank under the hood, right? And you have your FDIC protection, right, and a high yield. Why people don't move, right? Why more people haven't moved, right? Why Chime has only 8 million customers? Like, what is going on? And I really don't understand, right? And I haven't found a very reasonable answer, right? Some time ago it was still okay. People lazy, they're not aware, don't trust. But come on, enough time has passed for people to realize that they're just leaving money on the table and they still don't switch.
I'm with you there. My hot take is that those banks are either going to have to change their business models and earn less, or they're going to be, at least on the consumer side of things, slowly dying businesses. Let's get the last question.
Maybe generation, right? Generation needs to
Yeah.
change, right? So that's kind of for Robinhood, it's a big bad, right? That the younger generation who grew up on Robinhood will inherit the money. So probably the same with all those balances in Bank of America and Chase that pay nothing, So maybe this is what it takes.
Okay. Now, here's our last question before we get out of here. You've said that e-commerce creates a strong foundation for payments. What are some companies that have capitalized well on this, and what companies have struggled?
Yeah, Affirm is a great example, right? So Affirm is essentially two things, right? The credit underwriting capabilities, right? That they can underwrite in real time a transaction, not the customer, like credit companies, right? They really score every single transaction and they can make a decision whether to underwrite it or not. But second part is distribution, right? I mean, they are just distribution kings, I mean, they've done deals with every retailer that was kind of worth making a deal with, and so and why this is magical, because you are at the right moment, right? So the person is found the thing that they want to buy, and they are buying, right? And we're there, right? This is where we need the money, right? We don't think about the money when kind of watching TV or something, we think about it in very special moments, and shopping is one of them, right? So Affirm is a very good example. And if we go outside of it, then Latin America, clearly, Mercado Libre, right? Southeast Asia, C with the Shopee, right? They are the e-commerce platform. They are there with the customers when customers make a purchase, and they are there to offer them the loans and what's not.
Right.
It's just that in the US, somebody else is filling this role, not Amazon.
Yeah, it's interesting that Amazon was not able to capitalize on that, but I guess they have very strong relationships with who is it? Well, Visa with the Amazon card and Stripe for processing.
Yeah, and kind of Affirm filled the void of lending at checkout, right? So, and I think they did it really well, right? Maybe in some of the markets, there was just nobody else to provide this function, and so the e-commerce platforms had to build it themselves, or they saw an opportunity, right? And Amazon saw a competition and decided that they will do it better.
Okay. Before we get to the disclosure and get out of here, tell the listeners brief elevator pitch about the Popular Fintech newsletter. I see some articles on there recently posted that I think are quite interesting. How Coupang missed the fintech opportunity, how Mercado Libre built a fintech empire, stuff I think our listeners will very much enjoy. So what is it? And for anyone interested, the link will be right in the show notes.
Yes, I write about publicly traded fintech companies. So really go deep, into the business model, into the financials, right? So how they make money, and kind of trying to catch the trends or the change in the landscape that would help them kind of make more money, right? So recently I explored the commerce platforms, right, like Coupang and Mercado Libre, but I wrote about PayPal, I wrote about Block and Adyen, and pretty much every publicly traded fintech company is covered there. So that's a place if you want to learn about these companies, and if you want to catch those kind of moments of change, right, where something is happening, which I believe kind of I notice and try to explain.
All right, wonderful. Jev, thank you once again for joining the show. We knocked another country off our list for guest in Estonia, so glad you were able to join from halfway around the world. But let's hit the disclosure and get out of here. We are not financial advisors. Anything we say on this show is not formal advice or recommendation. Ryan, Irony podcast guest may hold securities discussed on this podcast, may have held them in the past, and may buy, sell, or hold them in the future. Thank you to all the listeners for tuning in once again, and we'll see you next time.